This is Cece. Welcome to The Orbit. It is Wednesday, December 13th, and it is an FOMC rate decision day, which comes later today with the release, and then more importantly is the press conference afterwards with Fed Chair Jerome Powell. That tends to be the more volatile part of an FOMC day, is actually during the press conference. The statement is generally pretty known and well priced in by the market. There's always a couple of little nuggets on what language has changed from prior statements, but the press conference is where you see a little bit more of that intraday volatility, and then it sort of sets the tone for the rest of the day, and a lot of times that carries over into tomorrow. So we're looking at the expected move in SPX for today, which is about 0.5%. We are actually looking at a yearly chart here, so you can kind of see this this pretty incredible run we've been on the last month and a half, 2 months. And then zooming in, we're looking at out to Friday. We're only looking at about a 0.8%. You're getting slightly higher volatility for today than you would on a with the VIX this low on other 0 DTE days, but you're not getting much. So it's not like there's this huge premium increase that you're selling. So credit spread traders, you know what hour this is coming, so that you should just be aware. If you're opening positions or closing positions, just be around that. And speaking of that, as a reminder to traders, especially credit spread traders, we do have, or even any kind of multi-leg traders, we do have a SPY dividend at the end of this week to be aware of, and I think it's $1 and something. So be aware of that, and any sort of positions that are in the money, deep in the money. Be aware of your short strike being assigned early, especially that would happen in the next day or two. So if you have a SPY position that is deep in the money, either max loss or max gain or close to it, say it's like 95 deltas, be very aware of that, because you could get early assigned going into the dividend, because that is somebody trying to exercise and go long a stock, and then you do not want to be short stock into the dividend. One thing I did want to look at next is a lot of folks, when we're talking to traders and all, there's some interesting ways that people are using options to, not necessarily a stock replacement, but you're mimicking stock, but without all of the collateral involved with buying the stock. And one of the ones I wanted to show that's kind of interesting, and we're just kind of picking NVIDIA randomly here, because it's an interesting chart with that, we've got that high within range, and we've got the possibility for this stock to reverse and go lower. If you look at this yearly chart, you see this kind of wild range. So let's say you were bullish in NVIDIA. You didn't want to buy this stock, $476. One way, just looking out into, we're just picking February, for instance, looking at call spreads, obviously this is not necessarily that volatile, but it's a pricey stock. So we've got a $2,000, so this would cost you 20, this call spread with a break even at about 495. The stock's down near 475. So, that's a call spread. You're saving money by selling that 530 call. But one way to look at this is, all right, well, I'm risking 20 on this. Are there some put spreads, credit put spreads available that we could help finance this? So we're doing let's say you didn't want to be at the money. Let's say you wanted it to be a little bit more. Let's go down to like the 465 strike. This is 1,200, go a little lower, 1,000. Okay. So now what we've got here is we've got an at the money call spread out into February. We're expressing a bullish, probably about a 30 delta call spread in NVIDIA, bullish. And then we're trying to find things that help finance that. And we've picked this 460 put, and you can kind of see where that is on that chart. That is that recent low. So we're basically saying we are bullish in NVIDIA. We have a break even up above about $20. But, if NVIDIA doesn't kind of rip higher, How do we help finance that and bring that break even lower? And here's an example where you are selling a credit put spread. You're collecting about 10. So now you're in a position that costs about 10. You are more heavily delta than you would have been just with that debit call spread. So you're risking 10 here if the stock goes nowhere or if the stock goes slightly higher. However, if the stock were to go lower, you're actually risking 30 or 35. So it's much closer to a stock replacement strategy. It's a much heavier delta trade. You can find these where you're kind of doing them for for even money, but you do have to remember that you're not actually, your risk isn't 10 in this. It's actually more than that because of that credit put spread. And if you were to buy a call spread for 10 and you were to sell a credit put spread at 10 lower, your risk isn't 0. Your risk is actually 10. It's the credit put spread. So the way to do the math on this is it's the risk of the credit put spread plus any net debit you are paying for the position. If you are receiving a credit, then it is the risk of the credit put spread minus the credit you are receiving for all 4 strikes.